NASDAQ up 0.4%. Lindsey, S&P's down 0.1%. And we have seen a little bit of outperformance in the NASDAQ just in the last few weeks, although on the days when it underperforms, it's a little more severe. Where do you stand on whether investors should be allocating back into tech after a little bit of a rough patch or stick with cyclicals?
Well, I don't think investors should have ever left the tech space in general. I think they should have right-sized their portfolio to make sure they weren't so overweight tech. But I think just because of what Mike said, having some component of tech in your portfolio is important, because when there is uncertainty or a lack of clarity in the marketplace, you do see investors rotate back into some of these names because they are big names, longer-term names, which our economy is going towards to become more digitally connected, more socially connected. And so I don't think a lot of these names are going away anytime soon. They just might not be as exciting as some of the newer tech, maybe meme stocks that you see out there.
There's another class, and that is the pandemic winners. Wall Street gaining confidence that some lockdown winners will find success in a post-pandemic world. For instance, Atlantic Equities initiates Etsy with an overweight rating, saying it should benefit from a number of strong consumer trends, including growing e-commerce adoption and consumers' growing desire for more, quote, meaningful consumption. Peloton also initiated with a buy at Loop Capital. The firm says the impact from Peloton's treadmill recall is likely overstated. Loop is bullish on Peloton going into earnings, saying it consistently underpromises and over-delivers. This, Mike, has been a theme. Some of these have been the hardest hit, both Etsy and Peloton. Zoom video, I would put into that category. But a lot of the pandemic winners, even Lululemon, a lot of people just think that it's not the time for that as the economy reopens, and yet some of the companies are coming out and surprising investors.
Right. So this is where the debate comes in. Nobody ever, I mean, I think there was a bit of a straw man argument. People saying this stuff isn't going to go away. People aren't going to stop riding Pelotons or buying through Etsy. Nobody thought it was going away. The question is how much of the pandemic premium was going to come out of it. If you look at both of these stocks, they're down a lot, but they're only gone back to about October or November levels, meaning they've still retained a lot of that huge surge they had over the prior year. And that shows you that they still do, have a market expectation that they're going to have a durable franchise, even if you do have a lot of debate around the valuation.
Lindsey, more broadly, where are S&P 500 P multiples now as, I guess, earnings estimates and earnings numbers have caught up a little bit with the multiple, but maybe not fully?
Yeah, no, the PE ratio on the S&P 500 on 2021 is about 22 times, which is still elevated versus historical standards, which gets you to about 16 times. But it's come down steadily as we've seen earnings numbers move higher steadily, and the market kind of stay put in this range since about mid-April. So that's an encouraging sign, I think, for the market overall into the future. As earnings estimates move higher, I was very surprised with Q1 results because the numbers moved up swiftly going into the reporting period, and then there were big beats, and that's pushing second quarter numbers higher and also second half numbers higher, where you're going to see a little bit of tougher comparisons. Granted, on average, the third and fourth quarter of 2020, we saw earnings decline 4 percentage points. So it gets a little bit tougher, but still not the toughest comparisons that we've seen. Overall, though, earnings estimates moving higher is a good thing for the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.